Hello, everyone. Today on the final bar, we'll talk about a market continuing to transition, if that's the right word, but certainly a divergence of sorts. 3 of the 5 days this week, including this one, you had the S&P up, you have the Nasdaq down. You have the Dow up, the Nasdaq down, the S&P somewhere in the middle. This speaks to a continued rotation, continued lagging of technology, but continued opportunities. Ladies and gentlemen, this is the final bar. Hello, everyone. Welcome to the final bar. I'm your host, Dave Keller. I'm the chief market strategist here at StockCharts.com in a sunny and warm Redmond, Washington. Thanks for joining us every weekday after the close as we make sense of these markets together, focusing on the message of the markets themselves. So much speculation, anticipation, anxiety, uncertainty about what is next for stocks, and there always will be. One thing that you do not have to speculate about is where prices have been. The record or the report card of the markets for individual stocks, for groups, for sectors, as reflected by the charts themselves, is the most important thing to look at. We always would talk about how the charts of stocks you own, that's your report card. If you want to know how well you're doing as an investor at any size, a small investor in your own account or a large money manager running billions of dollars, look at the charts of the stocks you own. Look at the charts of the stocks you don't. That immediately tells you if you're getting it done or not and focusing on the right opportunities at the right times. Having said that, we have some fantastic guests coming through this week. Had some really good conversations that I was super excited about. Willie Delwich this week, Dana Lyons, others were fantastic. Next week, more of the same. We have Jason Geffert coming up on Tuesday, the 16th. He's at Sentiment Trader in Minneapolis. Wednesday, the 17th, Craig Johnson from Piper Jaffray. On Thursday, Tony Dwyer from Canaccord Genuity in New York, also Dwyer Strategy. Coming up on March 22nd, Chart Madness, our stock picking competition for experts, if you can call us that. Myself, Grayson Rose from StockCharts, Tom Boley from Earnings Beats, and Greg Schnell from GregSchnell.com. We all now have a bracket of stocks that we will be debating and discussing. We will pick our favorites, talk through the bracket matchups, and identify our top contenders, the final four in each of our brackets. We welcome you to follow along and see how your choices may differ from ours. That's coming up on Monday, the 22nd, called Chart Madness. Want to get to our Wrap the Week segment. Best part of Friday is focusing on how the markets have evolved last Friday to this Friday, and it's been certainly, I keep saying a market in transition because it's the best way I can describe it. We've had this situation of one set of leadership that's changed, and I think we're going through the growing pains of that transition. Before we get to the weekly wrap, I want to start with a poll question. We asked you recently on our StockCharts TV feed, will the next 10% move in the S&P 500 be higher or lower? I love asking this question just to see where everyone's heads are at. When we asked this over the last couple of days, 71% of you, 7 out of 10 said higher. 29% of you said lower. If we go to the chart, we close, let's see, around 39, 40, maybe a little above that. So these are going to be a little off, but this isn't going to be too far off here. I threw 10% higher and 10% lower. Let's see if we bump this up just a toe. There we go. So that would mean an upside objective of around 43.36 if we would go 10% above current levels. 10% below current levels would take us down here around 35.50, 35.48. So it's interesting that 10% move lower wouldn't even get us. It would get us halfway down to the September low. That's how far we've come out of here, but it would take us back to the upper end of that congestion range and the first pullback after the breakout above that, those previous highs. It's kind of an interesting level, and the 200-day moving average wouldn't be that far from there, depending on how quickly of a pullback that might be. But only 3 out of 10 of you thought that was the more likely outcome. 70% of you are suggesting the next 10% move is going to be higher. Boy, I did not vote in this one. If I voted, I'd probably say lower. And you can tell that just from the way I've been thinking about limited upside and potential for downside, given the exhaustion signals that we've had. But boy, days like this, where we continue to move higher, charts like Viacom and others that just continue to pushed to the upside, banks and energy companies and others. It's hard to deny that there's a very real probability we go in either of these directions, but 10% above is not unrealistic given the strength of the move that you've seen here. The question is, what would technology do? The question I would ask is, what would technology be doing in that scenario? And I would argue it would have to be participating. So, semiconductors, Apple, others that have pulled back have gotten to the lower end of this range and certainly look like they're in a danger of breaking down if they haven't broken down already. Those would have to recover and start to participate. I don't see a lot of others, the rest of the market going up 10% and technology not even doing any of that. But that is one of many scenarios we could be faced with. Thanks for answering that question. Let's get to our weekly wrap. We'll start very quickly with what the market looks like Friday right now as of the close, and then we'll look at the weekly charts to finish off here. So very briefly today, as I mentioned, if you look at the top 3 listings on your market dashboard, you will see the story of most of this week, I would argue, which is the Dow up, the Nasdaq down, and the S&P somewhere in the middle. It's had some up days and some down days in the middle. The S&P opened much lower, obviously, and recovered back to finish just above 0 for the day. So it really was a barbell of sorts from the haves and the have-nots, if you look at it. So technology, the worst sector out of the 11, followed by communication services. On the upside, very defensive. You had REITs and utilities as the first 2. Industrials there, number 2, and then financials, number 3. These are going to chop around a little bit as we process the closing prices here. Mid caps and small caps, both with a decent day. And as we've talked about in previous shows and many times, right, when you look at small caps over large, that doesn't always just represent that investors are making a conscious small cap over large cap decision. Remember, it also reflects sector weightings. It reflects high beta and low beta. There's a lot of things that a small cap index means in terms of risk on and others. So certainly, 0.9% for the small caps, almost 1% up for the mid caps, definitely outperforming the S&P, which was flat for the day, and the VIX back below 21. Very briefly on other asset classes, yields continue to go back higher. So, this whole thing on the market, is recovering because yields are taking a breather. I don't buy it, because a day like this, yields are going up and stocks overall seem to be as well. So I don't think that's as one of a relationship as some might suggest. And we're back above 1.6%. The TLD has come off a little bit. The dollar index up about 1/3% today. Gold actually got back to flat. It opened up pretty low, around 159.50, but chopped its way back higher and finished flat for the day. Silver, though, finished down a little bit as well. And energy stocks flat to up a little bit on weaker oil prices. Cryptocurrencies, for the most part, down, with Bitcoin down 2% after being much lower earlier in the afternoon. Let's go to the weekly wrap chart. That's this one right here, and the labels may be a touch off, not too bad, but we'll see how we can update these. So basically, this is looking at some of the major asset classes. I like to start with the S&P 500, which is right here. Finished the week about up 2.7% from last Friday's close, where we're at right about now. Most things underperform the S&P, and that speaks to sort of the underperformance of other asset classes versus stocks this week is what it essentially tells you. In pink, I missed one label here. Sorry about that. That's actually the Nasdaq 100, which was up 2.2%. Gold was up 1.5%. Emerging markets up of 0.25%. If you missed my conversation with Dana Lyons, I want to say we were talking about emerging markets and a potential bounce. So I had not been paying as close of attention to that chart before our conversation. I'm certainly keeping an eye on that one. Crude oil flat to down a little bit today, 0.2% below 0. The dollar a similar amount, and bonds were the worst of all the asset classes we follow here, down 2%. That's just using the TLT as a proxy for bond prices. What outperforms stocks? Just two things. The small cap index up 7.4% and Bitcoin up 16%. And we talked in yesterday's show about an aggressive, but probably less aggressive the further we go up, upside target for Bitcoin, given a break above 58,000, which it did not do. It touched it yesterday, did not get it back above there today, but I think a break above 58,000 takes us up to the upper 70s, if not 80,000, not too far off, given the trajectory. That's another 20-25% above where we're at now, I would guess. Let's continue on looking at the Mindful Investor live chart list. This is what we look at every Friday, and it's sort of our big picture review of key themes out there. If you want to have this list, you are welcome to take it and copy the charts to your own watch list, do whatever you want with them. The way you can find this is go to the articles page. In the upper right, you'll see all stock charts blogs. Click on that and go to mine, which is called The Mindful Investor. And at the top, you will see a link, a little gray button that says live chart list. And you can click on that, save the individual charts, tweak them, edit them, do whatever you want. They're yours to enjoy. We'll start with the market trend. So I use a weekly chart and some exponential moving averages to determine a long-term, medium-term, and short-term trading model. And this is basically a long-term trend following model, really. I didn't update the label just yet. I do usually do a Friday after the close, but the short-term model had been negative for the last couple of weeks with this week's bounce higher, really driven by the value-y parts of the market. The short-term indicator will go back to bullish as of today's close. The medium-term indicator will continue to be negative, will be bearish, and the long-term indicator remains quite bullish. And to be honest, if I didn't have this in front of me and you asked me to tell you what the market felt like, it's pretty much how I would answer it. Short term, you can't deny the bounce that we've had this week. You can't deny the strength in a lot of individual charts out there making new highs. That's totally fair. Medium term, though, I think the weakness, the divergences we've had, the stocks that have sold off and really haven't recovered yet. And it's a lot of things. It's not just the mega cap tech. It's also things like Peloton and Zoom and others, trying to revive a little bit, but still nowhere near the high flying scenario that we saw a month ago. So I still think the medium term picture is mixed to down. The long term picture remains very, very strong. And any week where we make new all time highs, that indicator very deservedly should be in a positive. So that's about how it feels like in terms of where we're at with the divergences, with the long-term trends, and with the short-term bounce that we saw this week. I think that's about right. So the daily chart of the S&P certainly looks encouraging. It's hard to be discouraged by what you see here. I will give you the bearish argument because I've thought through it in many cases. And you probably hear from my language. I try to address things from as unbiased a perspective as possible. But obviously I'm an analyst, and I'm analyzing charts for clients and for many people all the time. So I always sort of have an opinion that I'm working off of. But one thing I learned over the course of my career, especially working with a team of technical analysts, was it always helped to have someone argue the other side of it. Even if you all agreed in one outlook, have someone take the other side of the argument and just consider the other side. So overall, I would think things are setting up very nicely for the S&P itself. Made a new 52-week high, a new all-time high yesterday. Did not repeat that today, but closed higher than yesterday. So a new closing high for the S&P to finish the week. That's pretty impressive. We have not yet broken above the, really meaningfully above the high from mid-February. So I think at this point, that is a key level of resistance. And the fact that we met that yesterday, sort of repeated it today, that is really the line to look at. We break above that. And again, I'm not struggling to find good charts out there. I think there are plenty out there. It's all about continuing to follow trends until they tell you otherwise. So we had, what could have been a major league head fake with the S&P getting below its 50-day and then reverting back above it. We'll have to see if we can eclipse this and go to new highs. In terms of other things that are concerning, what is encouraging is we bounced off RSI 40. That's when we pulled back to around 37.50. That's pretty encouraging, actually. That's what a bull market should look like. But the problem is, as we're making new all-time highs, the RSI is much lower than it's been in each of these previous peaks. So what happens is every time the S&P is going higher, there's less momentum behind it. That's not super encouraging. You'd want to see an increase in momentum if you feel optimistic about dramatically further upside from here. And that's where I sort of look at it. It's not that I don't think the market can go higher. The question is, can we go significantly higher? I'm doubtful of that. What does not make me doubtful is the strength of the trend measured by the cumulative advanced decline lines. If you look at the AD lines for these four major lists, common stocks on the NYSE, the large caps, mid caps, and small caps, they have all made new highs this week. A mentor of mine may have said, and if not, I probably am combining a lot of their guidance over the years into one quote, is don't be bearish when the advanced decline lines are all making new highs. That's kind of what I might tell a mentee of mine on a day like today. And so that's what I'm seeing. It's hard to be negative when you see this chart continue to go up. That tells you the market's in an uptrend and not to question it. You're also seeing an expansion of new highs, and this at times has been, part of the exhaustion thesis for me in January was an anemic number of new highs. We've seen that revert back upwards now. So now you're seeing, a decent number of new highs. Yesterday, you had 15% of the S&P make a new 52-week high yesterday on Thursday's close. Isn't updated for today yet, but that number may even go a little bit higher. That's pretty encouraging. That's expanding new highs are a healthy market. Less and less stocks similar to the RSI and lower momentum on upswings. You also have less and less stocks above their 50-day. But I think what's worth noting for me today is that in the last week, we went from 50% of the S&P above their 50-day up to 74% or 73% as of Thursday's close. That means as the S&P itself has gone below its 50-day, dipped below it, and reverted back higher, 25% of the index has done the exact same thing. That's pretty encouraging. Quick look at sentiment, and we talked about this really in detail on Thursday's show. So if you missed it, go check it out. But AAII bullish reading back up to 49%, very close to euphoric reading, but not quite there. The real story, I think, is the name exposure index, which has gone down from about 108% 3 weeks ago down to about 48% this week. That is a huge swing. It shows you that active managers are definitely tapping the brakes, if not stepping on them altogether. A lot of other things I could show you in rapid succession before we take a break are risk on versus risk off. And to summarize, they're all saying risk on. Equal weighted consumer discretionary over consumer staples. Relative strength of semiconductors, certainly not confirming that is one that does not agree with the bullish thesis, but small over large, that's a check. Equal weighted over cap weighted, that's a check. Growth under value, that is the truth. So these themes that we've seen starting to play out have continued to emerge. And again, there's enough stocks going up that it's able to digest the FANG stocks and a lot of technology names not doing so. We need to take a quick commercial break. Back answering your questions from the Final Bar Mailbag. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. Appreciate you joining us every weekday after the close as we break down the charts together. As a reminder, we would love to hear from you. We're going to do a mailbag segment here in a moment. These are all questions that you have sent in over the last couple of days, and I'd love for you to write us, put a comment in that we can see, and let us answer one of your questions in our next mailbag segment early next week. Shoot us an email, thefinalbar@stockcharts.com, on Twitter @finalbarsctv, or on our YouTube channel. Just put a comment below the video that you're watching. We'd love to answer one of your questions in next week's mailbag segments. Also, as a reminder, the new StockCharts TV app and website are all available for you. You can watch any of our fantastic programming, our great experts with all of their content featured on stockchartstv.com. You can set up a free account there. Also on all of the app stores, you will find StockCharts TV on demand. Again, just use your email, set up a free account. You can immediately start watching and enjoying some of the fantastic thoughts from my fellow hosts. Let's open up the Final Bar mailbag. And again, I'd encourage you to send in questions. It's a pleasure to point some of you in the right direction as best as I can. First question. My question is regarding tech's relationship to Bitcoin. Last week and historically, they seem to move in step, especially small to mid tech, as both are riskier, volatile sectors. This did not hold true through the weekend and Monday, and certainly through the end of the week. I think I would agree with that. Any insight? Do you see Bitcoin and or Ethereum moving higher, even though tech probably has further to fall before this correction is over? So honestly, I still think it's in a way, it's a bit early days to really be able to determine what Bitcoin is related to. If you look at correlations now, you will find times when Bitcoin and technology move in a very similar way. I would argue the fact that Bitcoin and tech moved up so much together is both of them were just in decent bull market phases, and I think they were both driven by a good amount of speculation. What you're finding with Bitcoin, and again, I don't think we've seen enough cycles with Bitcoin to determine whether or not it's a quote unquote safe haven, because that's what people think about with gold, right? Stocks go down, gold should go up because people fly to safety, and that just doesn't happen as much as we want to simplify it and think that it does. So, I would argue both of them had gone up because of a lot of euphoric sentiment. You've seen the euphoria unwind in a big way with technology stocks, and also with some of the smaller, more speculative technology names, some of the work from home names that have come down significantly. You really haven't seen that significant of a pullback with Bitcoin, although it's worth noting from mid-February to late February, it went from 58,000 down to 43,000. So that's a pretty big give back. However, given the volatility of Bitcoin, that's not that bad. And the long-term trajectory just remains very, very constructive. As you probably heard or hopefully saw on the show yesterday when I showed a long-term Bitcoin chart, I certainly see further upside for Bitcoin. I think there's a mix of euphoria and long-term speculation in Bitcoin. People aren't just jumping at Bitcoin and trying to ride it for the next couple of days. I'm getting the sense it's a lot of people investing for the long term and looking at much higher levels than this. And the institutional uptake that you're seeing continue to grow is what would continue to fuel that higher. So having said that, yeah, I don't think there's necessarily as much of a tie between tech and Bitcoin, just like there's not a tie between Bitcoin and financials, but there are times when the two of those have certainly moved together. I would be thinking more of them independently. Next question. I believe this chart originates from another video on YouTube that I watched. Let's see. I'd be interested in your take on it. The comment in red is the essence of the argument. This is the chart that you shared, and thanks so much for sharing it with us. So very quickly, yeah, so what this is a weekly chart of the Nasdaq 100, and it's going back to the 90s, and you're kind of showing this period in the mid 90s, which is interesting. As I might have mentioned on the show, I'm reading a book called Bull by Maggie Mahar, and talks about 1982 to 2004, and really talks about this, sort of bull market phase and just some of the telling signs along the way. And you're looking at this channel here, and then you see the tech bubble as sort of a blow off top going outside of that normal range. And that was an indication of the end. The question is, are we in a similar thing? So what's interesting is what you've done at the beginning here of this chart is you're kind of taking the 2009 low out of it and then restarting the trend here. And to be honest, I was at Fidelity during these years, and we did that with a lot of charts because the V bottom was so severe and so out of character for so many stocks. If you just skipped that and started at the next low, otherwise you'd have these huge steep trend lines that everything broke. And it just told you it was a V bottom, it was an acceleration out of the lows, and then we settled into a more normal trend. And I have no problem with this, which is basically representing the normal trend. And a lot of people would actually use regression lines or a regression channel to systematically to use statistical tools to measure the rate of ascent. And what you've illustrated here is absolutely right, which is we've accelerated out of the upper end of that channel. That's exactly how this market has felt, I'm sure, to many of us, as we've sort of gone outside of the normal range. What you're saying is, can we go back down to this range and then just continue up? That certainly is a possibility. And I think if you're thinking of downside targets for something like the Nasdaq 100, is that something that could happen? And what that tells you is that would continue to be within the context of an uptrend. I actually think that's a pretty compelling way to look at it. What it does is it shows that this recent move is an outlier move, just like the 2009 low was an outlier move. And I can't disagree with both of those things. I think that's a really interesting chart. I'm going to save that one and keep an eye on it. Thanks again for sharing that one. This was a really thoughtful question. It was really more of a teaching session. I learned a lot from your comments, the person that sent this in. But I was talking about gold as an inflation hedge. It's come up with a couple of my guests, and certainly have recognized the fact that gold really hasn't rallied. So if inflation fears are there, why isn't gold rallying? Because that's the hedge. Walter Deemer and I were talking about that not too long ago. Your comment was basically that's not what you need to watch. If you look at inflation, and look at the PPI, the Producer Price Index, one of the measures of inflation. CPI is obviously another one that many use relative to the 10-year yield. If you look at that on a weekly basis, you can see it fits the curve of gold pretty well. It's hard to see some of it, but I agree with you. The correlation is relatively strong between those two. You had a really interesting way of looking at that in a short-term basis, because the problem with PPI, it's a monthly figure, so it's hard to really understand the timing. This is using as a proxy the TIPS, the TIP ETF versus the Treasury Bond ETF, the IEF, and you're using that relative to the 10-year yield. So basically using ETFs to recreate a more real-time version of the chart that I just showed you. And as you can see here, you're absolutely right. This relative line of those ratios in the top lines up pretty well with gold. So gold would most likely turn higher when this turns higher, because that's actually with ETFs representing some fear about inflation. I think that's a brilliant way to do it. I had not thought of that, and I appreciate you sharing that with all of us. That's a really good one. Let's see. I agree. This is when I posted something on Twitter, probably a little less bullish than many. And the comment was, "I'm wary in my positions, yet MACD cross towards north." Let me see. So you're looking at this, and basically looking at a MACD on the S&P 500. And you're seeing this pattern right here, which is basically, and I'll stretch this out so we can see it a little better. So your comment is basically, look, the MACD is giving a buy signal, so isn't that positive? And you're absolutely right. So the thing that does not look that negative is the chart of the S&P, and especially things like the breadth readings, like the advanced decline lines. This is why I don't know what I would get when it gets completely bearish, but I'll start getting louder and probably more clear in that we've broken down. We have not broken down, and to the contrary, we're actually breaking out. We're continuing to turn higher, and the MACD signal turning back positive is certainly an indication of that. The weekly, the market trend model that I call the medium trend model is the weekly MACD, basically a weekly version of this chart, which has not turned up quite yet. So the bounce that we've seen this week is not enough to satisfy yet. If that satisfies it, I mean, if that turns positive next week, I would certainly continue to be looking for long opportunities. The configuration of it right now with the weekly MACD still negative tells me to not be looking aggressively for new ideas on the upside, to enjoy the uptrends that we're in and wait and see. It's tough right now though, because I'm seeing a lot of stocks look higher. And again, I think, remember, if you oversimplify and just look at the S&P and think of that as the market, that's fine if you're you're invested all in passive products, but hopefully you're finding you're empowered to look at opportunities elsewhere. And I would certainly hope what this environment tells you is just owning a bunch of stocks passively isn't a great way to navigate this sort of environment. There are stocks that are doing really well. There are charts that are going up a lot. I would want to own those and not own the things like big tech, which are not going up. And so this is a great opportunity to focus on places where things, what is working and what is not. It's a benefit of active management, in my opinion. That's all the time we have. Thank you guys all so much for those questions. We'll certainly get to some more at the beginning next week. Encourage you to keep sending them in. Email us, thefinalbar@stockcharts.com. We need to wrap the show and wrap this week with 3 charts, the 3 and 3, and it starts right now. Chart number 1 is breadth in the form of the cumulative advanced decline lines. We showed this in our wrap the week segment. Again, if I had one chart to pay attention to, it might be this one, because it has been very easy to get very negative. And you've heard it probably in my comments at times, because I'm seeing breakdowns. I'm seeing bearish divergences from semiconductors. And if you told me semiconductors would have a huge bearish divergence and break down to the point that they had, and the Nasdaq would be down 20%, what would the market overall be doing? And I would tell you the market's a disaster, and it's not. These lines are showing you that stocks overall, quote unquote stocks, the market is going up. When that stops happening, then you can think about getting more aggressively negative. We're not there yet. Chart number 2 that reminds me that things are pretty good. And again, I'm reminded of Willie Delwich's chart showing broker dealers. What else was in there? Broker dealers, the equal weighted S&P, and the DAX, I want to say, were the 3. It was a fantastic chart. And this is one that's showing you new highs. The expansion in new highs is actually very healthy, right? On Thursday's session, 15% of the S&P made a new 52-week high. That's pretty good. The final chart for the 3 and 3 is the stocks versus bonds ratio. Again, when I'm thinking about asset allocation, when you're thinking about where to be focusing, ratios like this tell you a lot about where you should be leaning and where you should be leaning, what you should be leaning into and what you should be leaning away from. There's nothing on this chart to tell you to own anything but stocks over bonds or to lean into that side of the ratio in terms of allocations. There's just been not enough improvement in bond prices, obviously with the scenario that we've been in. So that ratio is an important one to pay attention to. It's similar to looking at U.S. versus non-U.S., looking at small versus large, value versus growth. These ratios tell you a great amount about just the story. And what this is telling you is that it's still, if you think of stocks versus bonds, it's telling you which one has been working literally since the March low, with a couple notable pullbacks that were a little scary. Overall, it's certainly a net positive. Folks, that is our show and a wrap for this week on the Final Bar. Thank you all so much for joining us every weekday after the close as we break down the activity of the day. As a reminder, go to stockchartstv.com, set up a free account with your email. You can start watching all of our content. Also, we're on all the app stores, Apple, Roku, Amazon, everything. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a great weekend. We'll see you on Monday.
Hey Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.